Welcome back. At the full-year mark, Redefine has posted a near 3% drop in distributable income per share as well as the dividend. This as the high interest rate environment weighed. The property group has, however, seen improved occupancy and retention rates during the period, and with the interest rate cutting cycle underway, the group expects a recovery. Company CEO Andrew Konig joins us with greater perspective on the performance. Thank you so much for your time, Andrew. Of course, we know the diversification element of your property portfolio. Let's actually start off in South Africa with that performance. Would you say that the property fundamentals in South Africa have improved?
Absolutely, Zanati. The property fundamentals overall are improving. You can see it in our occupancy levels, where we've moved up just over the 92% level. And similarly, from a renewal reversion point of view, which has been under a lot of pressure, we are seeing the trend going forward, going positive. But I think what is important is something you said earlier about seeing a diversified portfolio at work, especially in this area where retail, for example, is doing very, very well.
Yeah.
Last year we had negative reversions of 4%. Now it's positive, only just, but it is positive. Industrial also, it came off a positive base last year, but it's improving even more this financial period. And then if we just look at offices, still in a tough spot, given the oversupply in the market at the moment, along with sluggish economic growth, that is creating a pressure point there on the renewal perspective. But I must say that from an occupancy point of view, offices are doing well. Our occupancy levels are improving, although market rentals remain under pressure.
Yeah, it's quite interesting to see that there's still pressure in the office market, and that really also just speaks to structural headwinds on that front. Considering where we are in the country and where we are going, pertaining to the GNU, and obviously the improved sentiment, improved business confidence, and the prospects for better economic growth, do you think that we could have any kind of structural shifts there that could benefit the office sector, or maybe that might take a little while longer?
But Zanati, you're absolutely right. The office sector needs some tailwinds. The tailwinds must come in the form of economic growth. So if we start seeing economic growth of circa 3% on a sustained basis, we'll be in a position to work off that surplus supply, and with that then will come a return to market rental growth in this area of the world, and then we will obviously see much better prospects for the office sector overall.
All right. Well, another pressure point has been for the government tenanted portfolio. You talk about a restructuring there. What has that looked like?
So, Zanati, just to explain to you, the government occupied offices have been running on month-to-month rentals, which were of historic leases, very high in relation to current market rentals. What we've now done is we have a partner that has enabled us to secure leases with the DPW in excess of 5 years, and it has brought down the rentals to market-related levels, but it's sustainable levels.
Okay.
And now we are starting to see a stabilization of the portfolio.
All right. Well, just talk to me about the Poland portfolio there with EPP, particularly concerning the geopolitical tensions, of course, the proximity of the ongoing Russia-Ukraine war. What are property fundamentals looking like there?
So Zanati, the Polish property fundamentals are sound. We have economic growth of circa 3% in that region. We have consumer spend that is increasing. We've got retail sales that are increasing, and you've got stability in that market. Although there is geopolitical tensions out just on the border of Poland, it is on the other extreme part of the Ukraine, being the western part that is free from the war. The eastern part is where most of the war that occurring, and that is quite far from Poland itself. So if you travel to Poland, you won't be aware of anything happening on its neighbours' front at all.
Yeah. Andrew, just talk to me about your asset recycling element of it, some acquisitions there, but also some disposals. What exactly is determining the kind of acquisitions that you have been looking at this point, but also what you have been letting go of?
So Zanati, just in terms of active asset management, almost every property is for sale at the right price. But having said that, we are targeting specifically non-core assets and assets that we believe have reached, from a growth a prospect point of view, their peak in terms of Redefine's investment strategy. So we've been selling off non-core properties or unproductive properties, if you like, here in South Africa, and we've been reallocating our capital to growth assets, assets that we believe over the medium to long term will deliver capital and income growth. So all we're doing is we're taking capital that has been allocated to assets previously that have now reached maturity, and we're recycling that back into assets where we believe we can get better and higher returns going forward.
Well, I mean, part of that asset management is acquisitions. And of course, we do know your acquisition, particularly for the remainder of what you didn't own in the Mall of the South, that did push up your loan to value ratio. They're still above 40. And I'm wondering, at what level of comfort are you with that LTV and also just managing that?
So Sonati, our LTV ratio in excess of 41% gives us some discomfort. At 42, we're not overly concerned in that we know that over the short to medium term, it will come down through a combination of capital recycling as well as asset appreciation, where there's also been stabilization in growth now in values coming through once again. So we believe that the loan to value is high at the moment, but it will trend back to our long-term range of 38 to 41%.
And then obviously talking about the next reporting period, Andrew, and the prospects there, are you expecting a significant uptick in growth momentum from here on out?
So Zanati, it's going to be a gradual improvement. We are guiding the market to a range from flat to plus 6%. And that will be premised on the fundamentals continuing to improve, as well as interest rates reducing to ease that finance cost burden. As we know, the Reserve Bank governor is quite conservative when it comes to his rate cutting, unlike the upward cycle that we have experienced. So we are expecting a gradual decline in interest rates over the next financial period, which will bring relief to the finance cost. But I do believe that it will be a gradual improvement, but a constant one into that positive territory back to inflation kind of linked returns.
That was Andrew Konig, CEO of Redefine Properties.